Problem 9.1b requires that we prepare a budgeted income statement along with supporting budgets. We are working with a company called Mercer Farm Supply, and they manufacture and sell a fertilizer called Basic 2. We're told that they are projecting sales in terms of units of 40,000 bags for the first quarter, 50,000 bags in the second quarter, and the selling price is $63. We do not know how they determined that price point, but based on our study from previous chapters, we know the different techniques that they could have selected from to determine that selling price. Direct materials: each bag requires 5 pounds of crop at a cost of $3.80 per pound, and 10 pounds of dirt at $1.50 per pound. So we know the total cost for direct materials would be $5.30. We also have designed inventory levels for each of the quarters. January through March, they are requiring 10,000 bags of Basic 2, second quarter 15,000, third quarter 20,000. You see for crop in pounds 9,000, 12,000, and 15, and for the dirt 15, 20, and 25. Direct labor, the second component of cost, is it takes a quarter of an hour, 15 minutes per bag, and the hourly rate is $12. So direct labor would be a quarter of 12, which would be $3. Selling and administrative expenses are expected to be variable is equal to 10% of sales. So whatever sales are for a particular quarter or year, 10% of that amount would be variable cost. Fixed cost is of course $150,000, and this is per quarter. So 4 times 150 would be the annual amount should we need that information. Interest expense is a fixed amount, $70,000, and their income taxes are expected to be 30% of income before taxes. Clearly this is not the current situation in the United States, where the maximum corporate tax rate is 21%. We move on. We are given by our assistant 2 budgets. The manufacturing overhead budget, which shows expected cost to be 100% of direct labor cost, and the direct materials budget for dirt, which shows the cost of dirt purchased to be $682,500 in quarter 1 and $832,500 in quarter 2. Basically, we do not have to prepare those budgets because they have already been done for us. We are being asked to prepare the budgeted multi-step income statement for the first 6 months, so the first 2 quarters of 2017, and all required operating budgets by quarters. So let's begin. First, we're going to do the sales budget, and from your reading you know that the sales budget is the budget that we begin with, and it tells us what the revenue for each period, in this case each quarter, is expected to be. To get that, we take the quantity, which we were told is 40,000 that they expect to sell in the first quarter, and the selling price is $63, so we multiply 40,000 by 63, and they are budgeting $2,520,000 of the fertilizer in the first quarter. Second quarter, 50,000 units times $53 per bag, $3,150,000. So for the first 6 months, the first 2 quarters, we'd have a total of 90,000 bags at $63, and so total revenue for 6 months would be $5,670,000. We move on to our second supporting budget, which is the production budget. The production budget is going to tell us how many units we need to produce in order to sell the amount specified in the sales budget. So We know that we need to sell 40,000 units. That's what we have in our sales budget. We also know that they desire 15,000 units to be on hand at the end of each quarter. That was also given to us. And we are also told that they already have 10,000 units on hand. And so we take the expected unit sales, add the desired ending finished goods, total of 55, but we already have 10, so we only need to produce 45,000 units in the first quarter. Note also that the ending inventory or ending finished goods for one quarter or one period will become the beginning amount for the subsequent period. So notice, for example, the desired ending inventory of 15,000 units. It appears in the second quarter as the beginning inventory. So in the second quarter, we need 50,000 units to be sold. We require 20,000 units to be on hand, so we don't have stock out. So there should be a total of 70,000 units that we require. However, we already have 15,000 units from the previous quarter, and so in the second quarter we would need to produce 55,000. So 45,000 in the first quarter, 55 in the second, so a total of 100,000 units for the first 6 months of 2017. That's our production budget. That's a budget again that tells us how many units we need to produce. Now we are going to our direct materials budget, which is going to tell us what our cost for direct materials will be, or what we need to pay for direct materials given what we said we want to sell, and therefore how many units we need to produce. So we begin with the units to be produced, which would be derived from the production budget, 45,000. And we need 5 pounds, we were told, in order to make one bag. We need 5 pounds of the crop. And so we need 225,000 pounds. And again, the desired ending inventory is 12,000, which we were told earlier. And so there is a total of 237,000 pounds that would be needed. However, we have 9,000 on hand. Again, that data was given to us at the beginning of the problem. Okay, we have 9,000 on hand, and so we would subtract the 9,000 that we already have from what we need, and the total required then to be bought would be 228,000. The cost, we were told, is $3.80 per pound, and so we would have to spend, or be expected to spend, $866,400 for the crop. Normally we would have to do a similar direct materials budget for the dirt, but they told us that they already took care of that. So let's move on to the second quarter for the same material. Again, we plan to sell 55,000. We need to produce 55,000 pounds of this particular product in the second quarter, and 55,000 units. It's 5 pounds that we need per unit, so that's a total of 275. We desire to have 15,000 on hand for the second quarter, so total desired would be 290,000. We already have 12. This 12 would be the amount that we ended in the previous quarter, so we deduct that and we end up with 278. Again, the cost per pound is $3.80, so we're looking at $1,056,400. So the total cost of direct materials that we would need to purchase so that we can sell the units that we indicated is $1,922,800. We move on to our next budget, which is the direct labor budget. So you notice that we're having a budget for each component of cost: direct materials, direct labor, and if we were required, we would have done one for overhead as well, but that was already done for us. And so we do the same thing. The units to be produced based on the production budget, 45,000, and the required direct labor hours per unit, they said it needs a quarter of an hour, so 0.25, so we would need 11,250 hours. We multiply that by the hourly rate of $12, and so direct labor is going to be $135,000. We do a similar thing for the second quarter. 55,000 units that we need to produce based on the production budget, a quarter of an hour for each of those, so it's 13,750 hours at $12 per hour. So we're looking at $165,000 for direct labor. The sum of those two would be $300,000, sorry, for the 6 months. 135 plus 165. We move to the penultimate budget, which is the selling and administrative budget. I refer to it as the SAB. We do the same thing for each quarter, and then we add to get the amount for the first 6 months. So the budgeted sales in units based on the sales budget is 40,000, and the variable cost is equal to 10% of sales, which is 10% off the sales that we recorded here, so 10%, and we get 252,000. Then we were told that the fixed cost is $150,000. You can see that in the information that we originally had, or we were given, where we were told right here that the fixed cost is $150,000 per quarter. So we simply use that information here, and we have our total selling and administrative budget for the first quarter. Second quarter, same thing. We are planning to sell 50,000 units. You can see that the variable cost is going to be 10% of sales, so that's 315,000, given that we plan to sell 3,150,000 for the second quarter. So 10% of that will be 315. The fixed portion remains the same, 150,000 per quarter, so that's 465. And if you add horizontally, we have 567,000 for variable, 300,000 for fixed, so the total cost for S&A, selling and administrative expenses, would be $867,000. Now we pull this all together in the income statement, where we will have our revenues, we'll have our cost of goods sold, we'll have our selling and administrative expenses, we'll have our interest expense, and we will have our taxes to arrive at our net income. One piece of information before we do the sales budget, the income statement, is to just show how we arrive at the cost per unit. Recall we were told that for the basic 2 fertilizer, each bag, they will need 5 pounds of crop, and it's $3.80 per pound, so that's $19. For the dirt, they need 10 pounds for 1 bag of the basic 2 fertilizer. It's $1.50 per pound, so that's a total of $15. Direct labor, it takes a quarter of an hour for each bag of basic 2. It's $12 per hour, so a quarter of 12 would be $3. And then of course it says that the manufacturing overhead is equal to 100% of direct labor, so 100% of $3 would be $3. We add the 19, the 15, the 3, and the 3, and the total cost for each bag of basic 2 would be $40. So that's our cost per bag. So now we can go to the income statement. We already know our total sales for the first 6 months. We did that when we prepared our sales budget. And so we take this total here of $5,670,000. That is our total revenue for 6 months. We could have done a quarterly income statement, but the problem asked us for a 6-month income statement, so half of the year. The cost of goods sold is based on us selling a total of 90,000 of these bags of fertilizer, and each one cost $40. So 90,000 times the $40 will give us $3,600,000. Cost of goods sold subtracted from sales gives us gross profit. And then we take away from that our selling and administrative expenses, and that of course came from the selling and administrative budget. And so we have $867,000 that we report as a subtraction from the gross profit. We then subtract our interest expense. We were given the interest expense to be a flat $70,000 for the 6 months, and so you will notice that we report that here as a subtraction from the profit before income and taxes. So that takes us to $1,133,000. We then find 30% of the $1,133,000, and we get $339,300. We subtract the taxes, and so the net income or profit after taxes will be $793,100. Not required for this problem, but we could also have gone on to prepare a balance sheet, and we would be taking ending inventory, for example, from the production budget. We would also be taking the net income from here. We would be taking information from the cash budget, the ending balances, and all of those together would help us to prepare a balance sheet. However, that's not required for this particular problem.